Andrew, how you doing?
I'm good. It's good to be here. I'm excited to chat with everybody.
Awesome, awesome. So everyone, welcome to Lagos Angel Network's Lunch and Learn for Friday, 21st June. Andrew Furman is with us, and we're discussing about the power law, risk, return, how to balance your portfolio, and everything in between. So, guys, can we say a little welcome to Andrew? Some thumbs up, some hi, some hello, some something. Let's make Andrew feel welcome.
Yeah, so good to meet you guys. Sorry, well, what I'm thinking about if I am going through some of my examples, the numbers might be a little bit hard to track audibly. So if everyone's just fine to like chime in if something isn't making sense, just let me know. Sorry that got us off track to start. Great to meet everybody. Just a little bit about my background. So I am the managing partner of Kaleo Ventures. We are an early stage VC focused on primarily pre-seed with a little bit of seed investing across Africa. So our thesis is Pan-Africa. We are sector agnostic. We have two partners actually based out of Lagos, who some of you might know, Ife Oyedele, who co-founded Kobo 360. They were an early Y Combinator company, and then Irtumi Bokokui, who was a venture builder at Future Africa with E. The family office that started us, Henry Kasner, was an early LP in a lot of the other funds you guys will know as well. So we've got a lot of the same friends, early LP in Future Africa, Ventures Platform, CRE. So we've kind of been aware of and doing things in the African ecosystem for about 5 years. And I myself, I'm a member of Lagos Angel Network, Nairobi Angel Network, and Hoke as well. And one of the things that really excites us is not just venture in general, but I'd say the earliest stages of venture. And we are big believers, we think there's a lot of data to back it, that when the earliest stages of venture funding are built, and again, by that, I don't mean seed, I really mean kind of those angel rounds of funding to get people going. We think the data is clear that that is what catalyzes the rest of the ecosystem and really leads to robust growth across kind of all of those stages. So I'm really excited about the ecosystem as a whole. And when I talked to Solomon about this a couple months ago, I'm hoping that this can be, to some extent, a collaborative session. I know that a lot of us on the call are investors. We've done angel investing. We know the venture space. But I'm hoping to some extent to kind of go back to some of the kind of core tenets of angel investing. And then as a group, maybe chat through what does that look like for us to cast a vision for what land could be. So Solomon, I hope that's helpful background. Let me know if you have any other questions for me, but I'm hoping that kind of tees things up okay.
Great stuff. So that helps us to set like a background to what we'll be looking at. And there's usually a huge gap, between what people expect when they come into ventures as investors and what they finally come across, and so I was thinking that you will run us through what should you be looking at when you're thinking returns, not necessarily as a VC, but as someone thinking early stage angel round investing.
Yeah, it's a good question. So a couple sort of tenets to keep in mind. I think a lot of times, because the venture space is involved in tech and innovation and all of these things that seem very forward thinking, I think investors tend to overcomplicate a lot of the core concepts. So for instance, there are two that I think we need to hit on. Number one, and I think part of that's the title of the session, is the power law. So the power law, and I'm so sorry, I had a slide on this, so I'll try my best to just kind of go through this in terms as audibly as I can. The power law, depending on what you're looking at, you'll get slightly different definitions. It essentially means that the return distribution of individual investments in venture is heavily skewed. And we mean that skewed in the direction of there are not many investments that are going to return 10 or 15 or 20 times your money, which I know sounds great on paper, but in the venture world, that's kind of a worthless return. Most investments are going to return less than one. Some are going to return about one. And then there's going to be a heavy skew in terms of overall impact of the portfolio to investments that return 60 or 70x or above. So bottom line, the way I describe the power return, if you guys are familiar with the 80-20 rule, and in venture, it's more like the 90-10 rule. 10% of the investments that you make are going to return over 90% of the actual return of your fund or portfolio. So I'll say that one more time. About 10% or less, normally what that means is one or two investments are going to return over 90% of the actual return that you get across a portfolio. So that's kind of the first key concept. And I know if any of you guys are on the call, I'm sure a lot of you guys are active angels. I know a couple people here are very active in the venture ecosystem. I know this sounds like something where you kind of go, yeah, we learned this when we were 18 years old in finance class. I'm just shocked though at how many people forget this next one, which is everything in venture is based on expected return. So if you guys remember that very boring math equation, which is E and then parentheses, you have R, that's what venture is. And so tying into this, and Solomon, I'll pause because I can give a more in-depth example if it's helpful. When we talk about risk, we have to be very careful to define what we do and do not mean by that. And where I have seen angels go astray, or just people in the venture ecosystem go astray, is they'll say something like, well, I don't like angel investing because it's risky. I prefer to do Series A and Series B investing because it's less risky. That is a wrong statement if you leave it just at that, because that is ignoring expected return. It's like the people that tell me they were an early investor in some super hot deal that's now worth $1 billion. My first question to them is, when did you enter the deal? At what valuation? And did you get the expected bump you needed to based on the risk profile of them advancing to the next stage? So I don't buy the fact that angel investing is, quote, riskier. You have to define it. And in most cases, you can structure around risk. So I'll pause for a second. But those are the two core things that we have to remember is all of this is based on expected return, which means risk is not binary. It's not, there are some things that are risky and some things that aren't. And the second thing is understanding the power law at play in venture, which is you can't be aiming for 10x returns. You need most of your portfolio to return, probably not even return anything. You just need one or two that return 60, 70, 80x. If we remember those two tenets, we kind of change the outlook of what we're doing as angels. I hope that wasn't too much, Solomon.
No, that's just apt, and then it captures what I was looking at in terms of returns. And what's the difference though between what a VC expects as returns and what an angel should be looking at as returns?
Yeah, it's a great question. And one of the things I'll say, and again, in case anyone's curious, when I keep mentioning this data, kind of this word data, a very good friend of mine in Southern California runs something called Tech Coast Angels, so TCA. He was also the president of the North American Venture Capital Association. So when you hear me talk about data, we have seen some very large data sets of what has made a lot of the angel networks in the US or internationally successful and what's made them not successful. So going to your question, Solomon, one of the things that I see a lot is some of the people I see who are, from a founder perspective, the most frustrating angels are people that are actually venture capitalists as their occupation. Yeah. And I'll give you an example. There are a lot of people I know who are much better VCs than I am, right? They do a lot of Series A investing. But as they look at a pre-seed deal, or a deal as an angel, they'll decline it. And I'll say, well, why did you decline the deal? And they'll say, well, go-to-market's going to be hard. There are a lot of competitors. And as I'm hearing them talk, I'm thinking, yes, right? This is every single company. What they're not doing, though, is realizing how much lower of a valuation they're getting to compensate for those risks. So essentially, they're unable to take their Series A venture capitalist hat on. And angel investing, to be clear, is venture capital, right? I just make the distinction between a VC that is slightly middle or later stage cannot see things differently at the angel round, and they can't be comfortable with, quote, risks that they ignore at the Series A because the company's a little bit further along. So I think the encouragement I'd give is, I think some of the best angels can actually be venture capitalists. They just have to understand they're looking at different investments, different stages, different risk profile. And again, it's not that these deals are inherently riskier. And again, I'll give you the example, right? If you give me a seed deal at a $15 million valuation and you love that seed deal, actually, let me use rounder numbers. I'm hoping I can make this simple enough where you guys can hear the numbers on a call. Let's pretend that a deal comes into land and it's a seed deal. They're raising $1 million at a $12 million valuation. I'm ignoring caps, I'm ignoring dilution. Let me keep it math simple. So they're raising $1 million at a $12 million valuation. And let's pretend, let's pretend they've got 50,000 MRR. And then you've got a pre-seed deal that comes in that's raising 200,000 at a $2 million valuation. That's just raising MVP. So when we talk about risk, here's the right way to say it. When we look at that seed deal, has it been de-risked by a factor of 6? Because going from a $2 million valuation to a $12 million valuation, if the exit potential is the same, we are saying implicitly that the later stage deal has been de-risked by a factor of 6. And so there's kind of just this gut check as an investor, which is, do we think failure rates, do we think our knowledge of the market shows that we should be willing to pay 6 times more for the seed deal? And that's how a VC needs to think, is yes, a Series A deal is less risky if we're talking about capital loss. The better question is, how much more money are you willing to pay for that deal? And it goes back to what Warren Buffett says, which is it is possible to find fantastic companies that make absolutely awful investments if you overpay for them. And that's the distinction I think sometimes people who are in the investment space have a really hard time changing their mindset on as they think about seed investing.
Hey, Andrew, can you hear me?
I can.
Mm-hmm. Oh, okay, good. Nice to meet you. I was going to ask if everyone's on the Google Meet, maybe you still send out the slides just in reply to the invite. That way we could still see. Because I think that the examples you were using, I think everything was heard. So you talked about power law, you talked about expected return as it relates to risk, and then how you need to evaluate deals at the kind of pre-seed or early stage as compared to seed, and then evaluating the de-risking. So even your quote from Buffett was in there too. So I think we caught everything.
Okay, good. Yeah, I can see. Again, my hope when Solomon and I were talking about this, and I'm sorry, there's miscommunication here. I've given, for what it's worth, the same chat to the Nairobi Angel Network, which has, they've gone to like 300 angels, a lot of deal flow, and I just get really excited about, I think, what we could do in the West African ecosystem. So, and I know like a lot of us, I feel like you and I have probably been on some email threads, being honest, because he's a good personal friend. But I think it was more. None of this necessarily has to change what we do as venture capitalists, but as we think about land and how land functions and where we can benefit founders and how we can see the best deal flow, that's where I'm hoping kind of a slightly different take or understanding of this can influence what we do essentially as a network, if that makes sense. So I don't want to, I hope nobody's taking it as like venture capitalists are doing it wrong. They're not. They're better VCs than I am. It's just more, what do we have to tweak to make land the first stop for the top founders so we get the first look at deals? That's kind of what the hope and the vision is.
I'd be curious what because I've heard this too, right? That, and it seems like it's just bad common knowledge that's inaccurate, but that angel investors are taking more of the risk kind of earlier on. But what is your perception on what needs to change? Is your point of view that there aren't enough of the startups?
Yeah, it's a good question. So again, part of this, and it's an annoying kind of clarification, but a lot of it depends on what we mean by risk. So number one, very few people, not very few, that's not a fair thing to say. A lot of people, I've realized, don't understand how the cap stack actually works in venture, which, to be clear, I know you do. But in other words, angels are at the bottom of the cap stack. So yes, there's a ton of risk. But and let me use some fake numbers here. Let's pretend somebody's angel portfolio returned net 10% IRR, which would be incredibly disappointing for the risk they're taking on. On one hand, somebody could look at that and say, well, it's because of the risk in angel investing, so we shouldn't do it. But let's also pretend that their average entry valuation was $5 million across that portfolio. Well, without changing any of the actual investments they've made, if that average valuation comes down to like 2.5, so in other words, it doubles your return on the deals that you got an exit from, your net IRR, again, depending on how the weighting's done, is probably now in the mid-20s, which does make it attractive from a risk-reward standpoint. So what I'm sort of getting at is, it's not really fair to look at risk just in terms of the individual investments or the stage. Almost all risk can be structured around. And so when I talk to even a lot of impact investors who get a concessionary return, I'm not fully sold on the idea that some individual investments are impact or are not impact, because all of that to me is a valuation question. So when we look at angel investing, I think the better way to frame it is, how do you structure and enter a deal at a certain valuation, again, with the right structuring involved, so that the IRR does become attractive from a risk reward standpoint. Don't know if that makes sense. So like, in other words, I don't really have an argument back on angels have less risk. We don't. We're at the bottom of the cap table. We haven't even gone to market with a lot of our deals, but it's how much less are we going to get in terms of the valuation to compensate for that risk. That's how the expected return view comes into play. And that's how you make angel investments palatable. The last example I'll give, and this is going to sound, again, like very simple, but I don't know if any of you guys have studied kind of the 1980s financial markets, particularly in the US, but when junk bonds were created, nobody had done junk bonds before, or high yield bonds. And the reason is, and I put this in quotes, but they were, quote, riskier than corporate debt. So nobody did them. And all it took was one guy saying, well, hold on a second, what if we were compensated for that risk? And now high yield's one of the most lucrative categories in investment. So it was kind of, before that, it was, well, this is riskier on a capital loss basis. And then somebody just asked the question, okay, how do we structure to get compensated for that risk? That's what we're talking about in the angel world. So that's why I don't buy that some things are, quote, less risky, if that makes sense. Sorry if that was a long answer. It's just such a good question, and I'm trying to do this without showing any like numbers on paper.
So we have founders listening in on this conversation too. What should a founder do to make their startup more interesting to buy into, and maybe de-risk their startup?
Again, it's a good question. And what I say is, part of this does come back to the expected return, which is, in theory, so I've got a slide, which is, there are some considerations I'm not talking about. There is a floor at, like, in other words, an angel can't bring down the valuation to a $50,000 valuation to compensate for risk, because then we are suddenly getting into real issues of, there's going to be too much dilution, later stage VCs won't enter. So at some level, there are some deals that are just uninvestable. But I think the better way I'd encourage a founder to think about it is, for the risks that you can't mitigate, how do you structure your offering in a way where it's still attractive to VCs? So, like, for instance, if you absolutely cannot bootstrap for one reason or another, and you need somebody to come in, let's say at ideation, in theory, there's a structure that compensates an investor for that. Therefore, don't go to an investor asking for a $4 million entry valuation, because that makes absolutely no sense. So as long as you're willing to be flexible on structure and valuation, sometimes even like synthetic warrants can be a really good option. I think a founder, to some extent, should have a really good idea of structuring, not as good as a VC, but they should know what to offer an investor. A lot of times we just get really put off by a deal, not because it's a bad deal, but we talk to a founder who's just so oblivious to what reality is that it shows negatively on the founder's kind of research. So for instance, when I'm presented with an ideation deal and they're like, we think the company's worth $10 million, my thought is, this is absolutely bananas and I'm not even going to touch it. So I think as a founder, what I'd say is, more so than de-risking the business, I think if you understand the structure, understand the tranching of investments, understand the risk you're asking an angel to take, you can probably proactively present them with a structure where they can turn around and say, this founder understands the risk I'm taking. They understand how rounds work in the venture ecosystem. And then there is a way to make those terms align with what somebody needs to see on the return side.
Okay, I just have one question to ask. As an angel investor, considering the fact that startups does not have a, like early stage startup does not have much traction, and then there are some VC firms that focus on, the stages and then the location. So how do you identify? So those, those metrics helps them identify, outliers. So how do I identify outlier, like companies, outliers as an angel investor? So that's just the question I want to ask.
Awesome.
Yeah, so great question. Very short answer, you can't. And that ties into one of the other things that makes angel networks successful. The best angel networks that we've seen, again, this is not based on what Andrew Furman thinks. This is based on a very good amount of data from a large amount of angel networks that have been around a while in the US. There is a incredibly positive correlation with the number of deals angel networks do to their success. So again, my friend that I mentioned who ran the North American Venture Capital Association and Tech Coast Angels over, I think it started in 98 or something. So I guess like 26 years. I think their net IRR, the last I saw across all investments, was I think a net 38%. Where angel networks mess up, and this ties back into what I was saying on some of the worst angels I've seen are some of the best VCs I know. And let me be clear, none of that is on land people. I mean this in the US. But you have to do, the numbers would say you probably have to do at least 25 deals, likely closer to 30 or 35, to ensure that you revert to the mean average of what you should get in the angel ecosystem. So what I would say is where I think land, this is one, the due diligence needs to be very fast. These companies, most of them are pre-revenue or they've just launched. There's not a lot of due diligence to do, right? We're betting on the market size and the founder's execution. So what I think is better is instead of an angel saying, hey, I want to find a deal and put $50,000 into it, I think they'd be much better suited to find, let's say 20 deals that they can put $2,500 into. So the success we've seen with angels, and going to your question on outliers, you cannot identify them early on. I've seen a couple people try to put together data sets on identifying outliers. And the reason I know it's bad is Sequoia still has about a 70% failure rate on their late stage investments. So it's just not possible. So the way you do that is doing enough deals to revert to the mean. Essentially what we're trying to do is reduce type 2 errors, if anyone taken the stats class, which is we're essentially willing to, quote, throw money away, small checks on deals that don't work. We're trying to avoid ever missing out on a deal that could be big. And we do that by numbers. So I think land is going to be so what we're trying to get land into is how can land be the first stop for the best founders? If we have a YC founder who has an exit, how can we make land where the due diligence is fast, the money comes in quick? And we're going to do that by doing a lot of deals. And if we write much smaller checks, but at a higher velocity, that is, I actually think, going to positively increase the return potential we all have. So again, sorry if that was a nuanced answer. You cannot identify outliers. It's possible to, obviously, we all know what an awful deck looks like. We all know when we talk to a founder who definitely shouldn't be doing this. It's easy to eliminate the awful deals. But between the mediocre deals and the slightly bad deals and the great deals, there's no way to know. And so you do that by numbers and lower check size entries.
Andrew, you mentioned due diligence. What should we be doing as angels when thinking due diligence?
Yeah, a good question. So I think this is something that to some extent has to be the network being in alignment. Angel due diligence should be minimal. And the reason I say that is there's not a lot to due diligence. For instance, let's think of all the investments we've done in the past. How many do we know that within the first 6 months of launch did not pivot? I'm assuming that number is less than 5%, right? Almost every one of our portfolio companies is pivoted. So where I mean, I just don't think a lot of this due diligence is helpful is we're going to spend so much time digging into a specific product. Like I've seen people spend 30, 40 hours of due diligence at the angel stage digging into a product. They write a check and a month later the company pivots. And it's like, man, that was like 40 hours of wasted due diligence. Our view is the best due diligence is done after we get on the cap table with a small check. So what I would say is as a network, I think to some extent, we just kind of need to figure out what is important to us and what actually matters at this early stage. I think, again, like having a co-founder CTO is a big thing we look for. We obviously need a big total addressable market unless the company is literally creating their own market, which those are few and far between, but they exist. So if we see, a big market with a tech co-founder, somebody who's commercially aware, people that understand the problem, that should tick most of the boxes for an angel investor. Because again, that's what we're betting on, right? Private equity is betting on a company because they can fire the founder. Venture's the opposite. We're betting on a founder because they can change the company. So I think our highest weighting are these capable founders who can execute quickly, and is the market big and the problem real? There might be some other small things to be clear, but I think if you have a very streamlined process, that's really helpful. And then to be honest too, I also think there's a gate where this is my preference. I don't think angel networks are that effective when they're looking at a lot of deals that are, 20,000 MRR and above. Because at that point, they really are starting to look at more like institutional investors. I think angel networks can do well, and the small checks can matter when we're really catalyzing that earliest stage. So again, the goal here, I think, is the ecosystem in Africa across venture is going to be healthiest when the angel ecosystems are thriving, and we can catalyze a lot of founders who can get out there, see what's working, see where they need to pivot, see what they need to iterate. So that ties into a very lean, streamlined due diligence process, because there's not a lot to due diligence. We don't have audited financials. They probably haven't made money. They're going to pivot. So it's just keeping that in mind with the due diligence we decide to actually do.
Good.
So I just want to ask, considering the fact that a lot of venture firms now are looking at power law, they are looking at power law before investing. Is one of their guiding principles, because they are actually looking for firms that these startup companies that will return the higher volume of fund back to them. So how do you advise startups when they are preparing because I've seen a lot of startups now, they will tell you they are into AI because a lot of venture capital are looking at the return on investment in the AI industry. So how do you advise startups do you advise startups to prepare their when they are setting up their company, they should also consider power law, like they should also put power law into consideration before sending their pitch deck or having a meeting? So that's my question.
It's a great question. So what I would say is, again, I think I'd encourage you to look at it from a different angle, where the companies themselves, I don't think, need to be as focused on the power law, because again, what this goes back to is the expected return I mentioned. The power law isn't necessarily, like, I'll give you an example. At Kaleo, and I'm assuming there are some other VCs on this call, but when we look at our financial model, we're anticipating probably a net 30 to 35% across the fund in terms of an IRR. We actually don't have any forecasted exits above $100 million. So none of our forecasted exits are above $100 million. And if there are any VCs on the call that are Series A, alarm bells are going off, because they're thinking, well, that doesn't get you the return you need. The power law, though, is not a function of how big a company can grow in terms of dollar amount. The power law is a function of what multiplier was there on your original valuation. In other words, the power law is closer to being in effect if you entered at $1.5 million cap and the company exited at 80 than if you entered at 100 million and the company exited at $1 billion. Now, the second story sounds better because you got a unicorn. That doesn't necessarily mean you've hit it rich with the power law. So let me know if that makes sense. So the power law isn't a function of what dollar amount a company can get to. It's a function of how much of a multiple on the valuation can you get. So I know people who returned literally 5 or 6x a fund, so 5 or 6x MOIC on a fund, with exits literally below $70 million, because they're early angels. They get in and they structure deals well. So let me know if that makes sense. But again, it's we can complicate the math in our head. It's literally a entry. I mean, when I'm talking about valuation, we're technically talking about price per share. I'm just ignoring dilution for the sake of simplicity. But literally, that's what we're looking at, is that multiple. We're not looking at what was the end valuation the company had.
Okay, so my question is, I understand a little bit of power law. So what I'm saying is, you're sending the deck to a fund manager, which is a venture firm. So they are now considering, now before they invest, they look at the power law. That is what guides them before their investment. Okay, what do I stand to get? At the end of this, before exit or acquisition, how many X am I getting? Either 10, they have all those things that they have carved out. Yes, it may not be accurate, but they have done their projection. So now, at the other side of the coin, which is where the startup and the founders are, okay, how do I prepare? Are you advising the, because most you fund manager, and then a founder is sending the pitch deck to you, and there are things that a founder, because I've seen a series of companies now that will just go online, they tell you they are into VC. You see a hair product is telling you they are into AI hair product and all that. They are just looking for words, to just embellish their products to make sure they please their, what is it called? they please the investors. So what advice what advice would you give a startup company when it comes to preparing some of these documents that they are sending to, the fund managers and the investors? So what is the advice? Because should they put power law into consideration? Because a lot of applications, a lot of documents have been passed off as a result of not meeting, their they may not say it outrightly, but they have, inner motive, the documentation and what they want to get at the end of the day.
Yeah. No, so I hear you, but again, sorry, I'm gonna try to say this a little differently. The only aspect of the power law that the founder, in terms of the documentation they prepare or the conversation they had, that they're involved with is the entry valuation. That's the only thing. And again, I know the gut reaction is like, well, should we talk about, the financial projections should be more aggressive? But my point with that is that's not the power law though, right? Because what that's showing is the nominal exit valuation. But that's only one part of the power law. The second part of the power law is what they enter at. So for instance, theoretically, there is a company that maxes out at 5 million of ARR. And let's pretend that they get an 8x exit multiple, which is probably too high, but let's pretend that gets them a $40 million valuation. Somebody could look at that and say, well, that's not a power law because it's not high enough. But there is math that exists where, like, let's pretend that company didn't need a lot of capital. Let's pretend that they needed $50,000. And a VC said, I'll give you $50K to $250 million valuation. Again, simplifying pre-post dilution, all that. So they've got 20% of the company. If they get that $40 million exit, that is definitely the power law for them, right? That's 160x return. So more what I mean is the only thing that's within the founder's control in terms of the power law is what they're offering in terms of an initial structure and valuation to an investor. The reason the end valuation matters from a nominal standpoint is that helps people figure out what that multiple is. But in other words, you could see a VC that's one of the top VCs in terms of decile returns, and they have no exits above $50 million. So like, I don't know if you guys track Techstars at all, but the Techstars CEO, this was like 2 months ago, there was a LinkedIn thread and they analyzed all the Techstars investments. And the essential conclusion was Techstars is awful because they've only had like 2 unicorns in the last 5 years. It was something like that. And the CEO came on and she said, this is really awful math, because even if we have a bunch of $700 or $800 million exits, if we get in lower, we'll have better returns than Y Combinator. And she was correct on that. So I don't know if that point makes sense, but it's the only thing that matters in terms of the power law is the entry and exit valuation. So I would say if the question is, what should a founder present to a VC? Ignore the power law. Make sure that your ask in terms of initial valuation makes sense so a VC can get to the power law on their side. So don't ask me for a pre-revenue company. Don't ask me for a $5 million valuation. I'm not going to give it to you. But that's really the only thing they should focus on. I hope that makes sense. I'm sorry if I was saying the same point again, but it's like, again, we can overcomplicate this where there are not many variables that come into play for what the actual effect is.
Thank you very much, Andrew. I had a question. Speaking more broadly about risk. So I was reading about the most favored nation clause recently for a project of work, and so beyond the power law being a way that angel investors can actually manage their risks, right? So knowing that they would get like several multiples on the investments in some of the companies. Speaking more broadly about risk now, how do angel investors also use the MFN clause, or it's something that's primarily restricted to venture capital firms? Or
yeah, it's a good question. Okay. Yeah, it's a good question. So again, number one, the very few angels I know will utilize an MFN clause, but it's primarily because the likelihood that anyone comes in on more advantageous terms is so low. Thinking about it in terms of a conversation with a founder, there's so many variables that you're essentially bartering on, right? Like you're going to have to bargain with them on valuation, on a lot of different things. Most angels I know, and this is our view, we typically don't have an MFN clause, and it's only because we care so little about that. I'd rather get like a little bit of a lower valuation. And so if we're going to a founder saying, hey, we want a 50% discount and we want a $1 million cap and we want, it's just too much. So what I'd say is most angels don't, but it's just because the risk of somebody coming in lower is almost zero. When you hear me talk about structuring, here's what I mean. Let's pretend that you really want to get into a certain fintech that comes in at a $2 million valuation. And the founder's like, no way, I want 5. There actually is still a way to make that a possible deal. So for instance, what you might say is, okay, I'll go in at the 5, but I want synthetic warrants. So let's say, and this is what we do, we've got a side letter attached to a safe, and we might have 3 months to execute on another tranche of funding at pre-agreed terms. So all of this, again, is basic math. This is options theory. If anyone's looked at the Black-Scholes model, we might say, hey, look, we want to get in at 2. We think the company's valued at 2, but I'm willing to go in at 5 if we can invest another $100,000 at 5 within 12 months. And they might say, no, I want the follow-on valuation to be at 7. And we might be able to say, okay, we can make that work. But instead of the 12 months, we want 18 months to execute on those options. So that's more what I'm getting at, which is there are so many different ways you can structure a deal to make the math come out to the same expected return. Does that make sense? Again, I'm sorry, I'm doing this without like a slide in front of me. But does that make sense where like options pricing, options are more expensive the longer they are to execute. Options are more expensive depending on what the delta of the strike price is, right? That's what we're talking about here. So there are always ways to structure around risk.
Awesome.
Yeah, that's great.
And I'll throw another one out there. Let's pretend that you think a company's really risky because they haven't launched yet, and they're asking for $50,000, but you know they only need $25,000 between now and launch. Instead of writing $50,000 right now, why don't you write 25? And the second 25 is contingent on that yes or no event of did they actually launch and monetize. So some angels would look at that and say, oh, it's too risky before launch. Yeah, it is very risky. That's why we're getting it at a $1 million valuation and not 5. So that's what I mean. There are almost always ways to structure around the risks that we talk about.
Great. So we've had quite a conversation around the power law, and Andrew has been literally shutting this place down, killing it, and we're really grateful. I'll just make a pointer to a couple of things that we already said, that as founders, you don't need to bother about the power law. Just be objective, be truthful, and put your best foot forward. Leave the investors to use the power law as a sieving technique at their end, but as a founder, you want to do what you want to do. And for the investor, due diligence is critical. Andrew also mentioned that, hey, you don't need to have extensive due diligence, but of course it's got to be there. Andrew, as we try to tidy this conversation now, I would ask you to, push out your vision for LAN like you had enumerated earlier. I'd like to hear your thoughts on that, the vision for LAN as regards to use of power law and how we should move on going forward.
Yeah, great question. So this is what I'm really excited about. I think the vision I'd have for LAN is I think we will know LAN is successful if we are not having to pull deals into the network, but we are the first stop for founders. So the follow-up question is then, like, for the best founders, right? We want the best founders to say, I'm going to go to LAN. So that begs the follow-up question. How do we make ourselves attractive to investors? I think number one, they need to know that we execute quickly. A lot of times angels, because they're VCs, there's so many questions they want to ask that they don't need to. I honestly believe that from a time somebody submits a deal to LAN, probably within 3 weeks, they should be able to get a commitment because there's just not a lot of things we work through. So if we can do that where we execute fast, we write a lot of checks because founders aren't going to come to any VC even too. Very few VCs or an angel network. If they know there's like a 1% chance of funding for an angel network, they will come to LAN if they know, they go, shoot, 40% of companies that go to LAN get some money. It's not necessarily a lot, but why wouldn't I do that? It's a quick process and I'm almost guaranteed to get some money. Because what LAN suddenly does is LAN will be the backer for any potential big deal in West Africa. So that's kind of the vision I have, is if we can really focus on, we don't need to be writing $250,000 checks, but if we can just write a lot of small checks, number one, that should benefit our individual portfolio returns because it means we've got a very high chance of reverting to the mean. But number two, it's going to make land much more attractive to founders, which means we're going to get much better deal flow. So that's kind of what I'm looking at, is to say, how do we get land the best deal flow? And I think we do that by a quick, incredibly founder-friendly process that has a much higher hit rate. That's typically what successful angel networks do. So that's the vision I have, is we could be responsible for really catalyzing a substantially higher number of founders in the ecosystem.
Yay, brilliant stuff. Whilst you said that, it felt like I was being given jabs, below the belt, but I'm stomaching it, and Adeolu is here, and we're all looking at how we, shorten the time frame between when we meet with founders and when they get checks. Really awesome. We would tidy this conversation, end this meeting with maybe one or two feedbacks from everyone, and Andrew tells us his final words and we run away. Anybody want to say something?
Thank you very much. Thank you, Andrew. I'm a founder myself, a 3-time founder, and one of the things that really, I was really happy to hear from Andrew is Angels Network being an angel, in terms of, not being like a Series A or a seed where there's so much, because as a founder myself, there's so many things you're trying to figure out. And if you can find that network who kind of understand that very early stage where a lot of things are unclear and you're probably going to pivot in the next 6 months or change your business style, I think that makes sense. Being able to quickly just turn around pitch deck as early as possible. Let us know whether you're interested or not quickly, because there's no so much due diligence you can do for an early stage startup, which is just trying to figure out product market fit. So I just want to say this has been very insightful, and we'll look forward to sending pitches and see how things turn around. And hopefully we can also be an investor in the future. Thank you so much for this. Thank
you. I particularly love that feedback. Thank you. All right. If we have no other, Tano, I see you. If we have no other feedback, Andrew, last words, and we run away.
Again, just grateful for the time. I appreciate everyone participating, kind of bearing with me on the front end there. I know it got off to a trickier start, but yeah, I'm excited for what the network not just could be, but again, if we execute on this, I think what we could do for just the ecosystem as a whole. So I'm encouraged by it and really grateful for the opportunity to speak to you guys.
Andrew, how you doing?
I'm good. It's good to be here. I'm excited to chat with everybody.
Awesome. So everyone, welcome to Lagos Angel Network's Lunch and Learn for Friday, 21st June. Andrew Furman is with us, and we're discussing about the power law, risk, return, how to balance your portfolio, and everything in between. So, guys, can we say a little welcome to Andrew? Some thumbs up, some hi, some hello, something. Let's make Andrew feel welcome.
Yeah, so good to meet you guys. Sorry, well, what I'm thinking about, if I am going through some of my examples, the numbers might be a little bit hard to track audibly. So if everyone's just fine to chime in if something isn't making sense. Just let me know. Sorry if that got us off track to start. Great to meet everybody. Just, a little bit about my background. So I am the managing partner of Kaleo Ventures. We are an early stage VC focused on primarily pre-seed with a little bit of seed investing across Africa. So our thesis is Pan-Africa. We are sector agnostic. We have two partners actually based out of Lagos, who some of you might know, Ife Oyedele, who co-founded Kobo 360. They were an early Y Combinator company, and then Irtumi Kokui, who was a venture builder at Future Africa with E. The family office that started us, Henry Kasner, was an early LP in a lot of the other funds you guys will know as well. So we've got a lot of the same friends, early LP in Future Africa, Ventures Platform, CRE. So we've kind of been aware of and doing things in the African ecosystem for about 5 years. And I myself, I'm a member of Lagos Angel Network, Nairobi Angel Network, and Hoke as well. And one of the things that really excites us is not just venture in general, but I'd say the earliest stages of venture. And we are big believers, we think there's a lot of data to back it, that when the earliest stages of venture funding are built, and again, by that, I don't mean seed, I really mean kind of those angel rounds of funding to get people going. We think the data is clear that that is what catalyzes the rest of the ecosystem and really leads to robust growth across kind of all of those stages. So I'm really excited about the ecosystem as a whole. And when I talked to Solomon about this a couple months ago, I'm hoping that this can be, to some extent, a collaborative session. I know that a lot of us on the call are investors. We've done angel investing. We know the venture space. But I'm hoping to some extent to kind of go back to some of the kind of core tenets of angel investing. And then as a group, maybe chat through what does that look like for us to cast a vision for what land could be. So Solomon, I hope that's helpful background. Let me know if you have any other questions for me, but I'm hoping that kind of tees things up okay.
Great stuff. Great stuff. So that helps us to set like a background to what we'll be looking at. And, you know, there's usually a huge gap, you know, between what people expect when they come into ventures as investors and what they finally come across, you know. And so I was thinking that you run us through what should you be looking at when you're thinking returns, not necessarily as a VC, but, you know, as someone thinking early stage angel round investing.
Yeah, it's a good question. So a couple sort of tenets to keep in mind. I think a lot of times because the venture space is involved in tech and innovation and all of these things that seem very forward thinking, I think investors tend to overcomplicate a lot of the core concepts. So for instance, there are two that I think we need to hit on. Number one, and I think part of that's the title of the session, is the power law. So the power law, and I'm so sorry, I had a slide on this, so I'll try my best to just kind of go through this in terms as audibly as I can. The power law, depending on what you're looking at, you'll get slightly different definitions. It essentially means that the return distribution of individual investments in venture is heavily skewed. And we mean that skewed in the direction of there are not many investments that are going to return 10 or 15 or 20 times your money, which I know sounds great on paper, but in the venture world, that's kind of a worthless return. Most investments are going to return less than one. Some are going to return about one. And then there's going to be a heavy skew in terms of overall impact of the portfolio to investments that return 60 or 70x or above. So bottom line, the way I describe the power return, if you guys are familiar with the 80-20 rule, and in venture, it's more like the 90-10 rule, 10% of the investments that you make are going to return over 90% of the actual return of your fund or portfolio. So I'll say that one more time. About 10% or less, normally what that means is one or two investments are going to return over 90% of the actual return that you get across a portfolio. So that's kind of the first key concept. And I know if any of you guys are on the call, I'm sure a lot of you guys are active angels. I know a couple people here are very active in the event, like something where you kind of go, yeah, we learned this when we were 18 years old in finance class. I'm just shocked though at how many people forget this next one, which is everything in venture is based on expected return. So if you guys remember that very boring math equation, which is E and then parentheses, you have R, that's what venture is. And so tying into this, and Solomon, I'll pause because I can give a more in-depth example if it's helpful. When we talk about risk, we have to be very careful to define what we do and do not mean by that. And where I have seen angels go